Hi there, traders. Now, I've got a good question here from one of our traders, Joshua. I traded the cash rate release yesterday. That was the RBNZ, but got out too early. I want to see if you can give me some advice to be better prepared next time, right? And what the situation was for Joshua is he's left a lot of cash on the table, and this can have a definitely emotional impact on you because you feel like even though you've made some cash, you feel like you've lost, right? So how can you get better prepared for this? Now, the central bank meetings up until this point haven't exactly been like exciting events, right? No real big shifts in the inflation, employment numbers, and these sorts of things, except outside the US. Except for the US. Now, the central banks, as they come back online, and what I mean by that is when they come back into actually managing the economy again, which it looks like they're all catching up now to the Fed, they are going to be events. Now, how can you capture this opportunity? So first and foremost, right now, as we come through this dynamic period where the central banks are starting to talk about managing the economies, we've got to start anticipating when they are going to start to say they're going to start doing things, start managing things. That's what when they're talking about bringing forward, say, potential interest rate hikes. Even if they're like 0.05%, it means they're active and things are moving, right? So we've had a climate of very low interest rates for a long period of time. There's so much stimulus across the global markets. It has to shift at some stage. So any shift from the central bank will be a buying opportunity for that particular currency. In this situation, the Kiwi. Now, how does this all start? Well, first and foremost, like all trading opportunities, you've got to know where your entry levels are, right? So the RBNZ started talking yesterday. They came out, they didn't change any interest rates, which was as expected. But the key to this is in the press conference, right? There was a few words in the statement, but nothing about, oh, we're going to change rates potentially next year. That came in the press conference. So there's a number of different parts. Understand the setup of the central banks. They have the central bank interest rate decision, and the statement is released at the same time. And then more often than not, the press conference following the event held by the central bank, and it's usually the president, the chairman, the governor, depending on where they may be. And that's where the real gravy is, right? So the statement is all about controlling the volatility in the market. They want the market to be comfortable with what they've said. The press conference gives them a chance to add a bit of extra flavor. And this is where the interest rate hike came into play. So if I just have a look here. So once they went, now where can you get in? So what you can be anticipating is, you know what, if they started talking about interest rate hikes, where would I get in? Well, you'd try and get in as anywhere you could, right? Close to where the market was. But this is an explosive event. So it's very hard to gauge where you could potentially be jumping in, to just get in at market. Well, in this situation, with the currency down here, we've got a resistance level here, right? Well, we've got two resistance levels on the top side, and I'll show you where they stem from. But they are two potential entry levels, right? Getting in above both of these, or one or both, so you can diversify your risk and go both, or just get in on the first break, because if they say anything about interest rates, the market factors in an interest rate hike straight away, and it's the same impact as them changing rates almost, right? So the first level here would be the best. The second level is a bit more conservative, but then it's broken. Okay, you're going to give up a few points and go with that. So now, how can you stay in the trade? Well, this is one of those events. Now, on a normal trading day with economic data releases, if they were big variance in the numbers, the currencies would move 150 points. Now, the Kiwi hasn't exactly moved 150 points here, but if it's a central bank announcement, they want the market to move. They want the adjustment to be factored into the market. It can potentially run a lot further than 150. Now, this only ran about 80 odd points. But what I'm trying to get through to you is the impact is almost not really sort of measurable, right? Now, the situation here as well, imagine if we had weak US dollar sentiment, the move would have probably been double. We have a bit of a situation where a static dollar, if anything, a little bit of dollar strength, it slows the move down, but you can see where it comes in. Now, how can you best get in and then hang on to the position? Well, using the first trend line is your entry. That's number one, right? That's your best entry point, probably just above 72.50. Now, to stay in the position, because we don't know how far it's going to run, this is a new event. The market's factoring it in. It could run 150, it could run 80, it could run 120. You just don't know. So the idea would be is when you have your entry level here, right, and you've got your stop loss down here, have a close trailing stop loss on the back of it. As soon as it goes up, say 50 points or 30 points, it's up here. You're raising your stop loss. Let me just clear that. So your entry position, let me just change the colors here. So entry here, it gets up to where that pink cross is. Automatically your stop loss, which was obviously below your entry, is raised to above break even, right? Give it a chance because you don't want this thing to pull back. We've got another technical level there. It's broken through. So if you're raising your stop loss to up here, and then as the currency moves to the top side, right? I'd say every 10 or 15 points, you make sure that stop loss keeps going up. Now, so the market level is here. By the time it gets up there, say your stop loss, I'd say about 15, 20 points is where you want it to be. Okay, your stop loss is up here and that's trailing, right? That becomes your profit level. So what that gives you the luxury of doing is not having to sit there and watch the market. This thing could shoot to the moon and you know you're going to maximize your profit potential using a trailing stop, right? Then you don't have to worry about what happens, right? You just hope it keeps going. If it stalls like it did here, right, just above 73, sort of 10-ish, you're out by the time it hits 90 and you've locked in your cash. The stop loss is triggered and you've maximized the move for this period of time, right? It's easier in hindsight, right? So don't get yourself bent out of shape if you're not sure that you didn't take all the cash, because this is a new move. The market wasn't anticipating it. The key to the whole situation is understand there's a meeting coming up. If they do talk higher rates, currency shoots to the top side. Where's your potential entry? Well, it's just above that resistance line. If you're using, say, Trendline Trader, then incorporating Trendline Trader, you've got your entry, you've got your stop loss, which is below the, say, you can even keep it tight, but say 25 points initially. As the currency shoots to the top side, so does your stop loss. And that's how you can sort of try and maximize your profit. Because if you sit in front of the screens, right, and this is where like just trading live can be dangerous if you're sitting there, because you see the currency move from 72.50, it shoots up to say 72.95 and it's back at 80 around here. If you're watching that price action here, you're probably going, you know what, that's done. I've just got to take the cash because it could be back down here very quickly. So you end up taking out, say, 20 points. And you know what? You haven't given yourself the chance. Use the management process of trailing stops or moving stop losses to make sure you capture the full move. And that's how you can capture these. Now the most important part of this is you've seen what's happened here with the RBNZ. Start anticipating potential opportunities like this with the RBA, the Bank of England. I wouldn't say the ECB are there yet, but any of the other central banks, we've seen 3 of them now, the Fed, the Bank of Canada, and the RBNZ do this. You know what the reaction is going to be. If you've got entry levels, the opportunity is alive. If you don't have an entry level here, like a support or resistance, depending on what the pair is, then you don't have a trading opportunity, right? And these are the trend lines. So we've got the high over here coming back to February. So this is your main resistance level. We've got a shorter term level here going back just through May, 1, 2, 3 touches. So that's an active resistance level, not as strong as the one behind it. And you've got a support line there. So technically, this is why you have your charts and your entry levels drawn up. So if something left field like this happens, you can have the trade in play or the order in the market, hoping to capture some random speech or anomaly from the central bank, right? And that's how you can maximize your opportunity out of these. Hope that helps. Any questions? Send us a message. Cheerio.